Friends, how we doing today? If you would have told me back when I started this dividend portfolio on July 20th of the year 2020 that I'd be sitting at where I'm currently sitting at in my dividend portfolio at $70,000, I would be probably not believing you right now. But the reality is, friends, if you have a game plan and you can execute and you stay systematic and you invest automatically, there's no reason why you can't generate wealth, why you can't build financial wealth. Build a good base, a good foundation. That way when you get to the future, right, your future self will turn around and thank you. It'll thank you for starting 20 plus years ago. And you at that point in time will be less stressed and you'll be in a more comfortable position. You'll be leveraged with time and you'd be happy that the younger version of you went ahead and started that dividend portfolio, went ahead and started thinking about investments and retirement when it didn't matter. You're going to thank yourself, friends. Stay focused on the prize. But as always, friends, welcome to another dividend investing video. This is a portfolio review for July of 2023. Might as well throw in the date in there because time is going to continue to tick, and who knows, it's going to be 2030, 2040, 2050. Time's going to continue to pass for us. But as always, friends, in these portfolio reviews, I'm going to go over some of the data. I'm going to tell you how much do I actually fund my portfolio currently and how often. I'll also break down some of my sector allocations and percentages. And with that, I like to jump into some of the best and worst performers per sector. I'll also share with you my current number of holdings, which, people tend to notice is quite a bit, but I'll explain why. And then my current dividends portfolio's yield, along with my expense ratio, which is fairly low. And then as we go further in the video still, I'll break down with you some of my current and long-term plans for the portfolio. I know we tend to do these monthly, but some things do change. So we'll see if it changed from last month or not. And then as always, friends, one of my favorite parts of these dividend portfolio reviews is I'm going to share with you how much my dividend portfolio currently pays me in dividends. And as we make our way forward still, friends, this channel is called Continues to Tick for a reason, and that's in reference to time, as time continues to tick. And if you're a dividend investor, you probably already know how important it is to leverage time, throw time into the formula, right? Into this formula of creating wealth over time. As a dividend investor, you can throw money at this portfolio all you want, right? You're going to be capped though. There's only be a certain amount you can fund. But over time, this starts to compound. Over time, the dividend starts to drip. And over time, you're going to end up with something that the future version of you is going to be thankful for, of you today, for having started. And as with all dividend portfolio review videos, I always have a topic that I do like to talk about. And this one, it's called the 3 steps I'm using to build wealth over time. And as soon as we're done with this topic, friends, we'll dive into a little bit more of the data and the statistics for the dividend portfolio itself, give you an example as well. Don't just talk about it, but walk about it. But the 3 steps that I'm personally using, friends, to build my wealth over time are these, and they are kind of in chronological order. The first thing is I'm protecting what I make. This is with the assumption that you're already making money, right? Step 1 is always to make money. What came first, the chicken or the egg? Well, in this case, money. Money came first. So you need money, of course, so I didn't even mention that. But the first thing is you got to protect what it is that you make. Protect your money. Number 2 is invest in quality assets. I'm investing in quality assets. I'm a dividend investor. I want to get into real estate, but I'm not quite there yet, but I will be. And the third thing is make more than what I currently make. And I'm going to go through these and kind of explain to you why these 3 work in sequence, why these 3 work in cycles. And it's through these cycles that you start to ultimately build a financial base and ultimately financial wealth. So let me explain. So going back a little bit, friends, I did say, of course, the first thing, it's what shall not be named because we should already assume this is the assumption, is that you need a career, you need to make money Through that money, that is your survival mechanism in this life. If you don't make money in this life, you're not going to be able to survive. You can tap out of the game if you want and not make any money, but then what is going to be the quality of life that you live? If you have ambitions to have a house, to have a family, to have cars, go on vacations, have nice things, maybe get your time back, you hate working at Home Depot or you hate being a barista, you're not going to be surviving on those type of wages for the entirety of your life. But the idea is you need to have a source of income. You have to. So apart from the source of income, friends, because my dad would always say growing up, because his grandma told him, and take note, my parents are immigrants from Mexico. They came here, with nothing. But they got here, and my grandma would tell my dad, who then told me, is that anybody can make money. Anybody, even a fool. Even a fool can make money. But now to protect it, to take care of it, or to spend it and know how to spend it is not just anybody. And I think that part is where a lot of wealth is actually created, is in this aspect of protecting what it is that you make and knowing how to spend it. Both of those things go hand in hand. You got to protect what it is you make. But in that process, if you were to ask somebody, how do you protect your money? Well, it has to come from the foundation of knowing how to spend it, knowing where it's allocated to, knowing how to budget, knowing how to maintain a budget and work within this budget. Because you can come up with the numbers all you want. You can do the paper math if you want to, but the idea is you have to be disciplined. I can hand you a formula of how to do it, but it truly, at the end of the day, is going to be up to you. How much you spend, how much you want to spend for trips, how much you want to spend for clothes, for food, for shelter, for leisure. It's always going to be up to you, but you're going to have to make money and then protect it and know how to spend it, know how to allocate it. So when I say protecting what I make, that is what I mean. I mean knowing where your money is going at all times. And there's going to be months, friends. This doesn't have to be a strict number like, I'm going to put $660.33 into my shelter. It doesn't have to be that exact. It doesn't have to be. You don't have to stress yourself out that much. But you have to have a general sense on any given month where your money is going. And through that process, you're actually protecting it. You're not mindlessly spending it, like a hole at the bottom of a water bucket and wondering where it's going just because you don't see the hole at the bottom of the bucket, right? Protect your money, know where it's going. That's the step one. The second thing that I do to build wealth over time, apart from protecting my money, let's say you make your money, you're protecting it, you budget, you know where it's going, you know how to spend. Now the next step is investing in quality assets. Crypto's fun, right? Investing in Nvidia is fun. But investing at crypto at the worst time isn't a good idea, right? When Bitcoin was at $60,000, that would probably be a bad idea right now. You'd be in the red about $30,000. Investing in Nvidia right now at its peak, some may argue it's not, but it's a lot higher than it was 3 months ago. Right now, investing into it and having it fall a little bit wouldn't be the greatest idea, right? But the idea is you have to invest in quality assets. You have to kind of pick and point and choose your risk tolerance first. If Nvidia and crypto catch your attention, but you ultimately want to build financial wealth over time, you have to be slightly more conservative. If your foundation is solid, yeah, go ahead. Buy that Nvidia. Yeah, go ahead. Buy that Bitcoin. But you have to have a foundation that is solid in quality assets first. We're a dividend channel here. So what's a quality asset? Well, of course, we would say dividend paying stocks are quality assets. They're mature companies, oftentimes blue chip companies that pay a dividend because that's how well of a business model they're running. They've been around probably longer than you have. I'm 27 years old. I think there's a lot of dividend companies I have in my portfolio that honestly are older than I am, probably longer than I've been alive as well. I would say that is a quality asset. A dividend portfolio in its entirety could be a quality asset if you build it right. I would say my dividend portfolio, because the way I've structured it, how I've had it over 3 years through COVID and all this madness, and it's still in the green, a pretty good amount paying me dividends. I haven't had any dividend cuts. I would say that is a quality asset. So as you protect your money, friends, the next thing is you do have to invest in quality assets. A big portion of people's wealth is made through investing. But don't just invest in crypto, Bitcoin. Don't just invest in that hot next stock, Nvidia or Tesla. You got to be careful. There's space for those. There really is. Those are fun. Those are exciting. But don't forget to invest in quality assets, which oftentimes are boring. It's like watching paint dry. I mean, getting cash flow from a rental property is pretty fun, but it's also quite boring, especially when you do it right. $200 every month here, $200 every month again. It's fun. I mean, that's awesome. Base hit after base hit is what I think is exciting. But in actuality, and compared to that high rise of Tesla, right? Nvidia currently right now, that's exciting. Not so much getting $7, quarterly from a dividend paying stock. But you got to recognize which one's quality and which one has a higher risk. And it's ultimately up to you to choose the balance, but I would recommend quality over risk. And the more quality assets you gain over time, the higher chance that you're going to be building wealth in a successful way. And then for the last part of this cycle, friends, because you got to make money, of course, then you protect it, then you invest it. Now you kind of reach a floor baseline, right? You reach this baseline again of, okay, I'm kind of capped. I can't really invest anymore. I've really budgeted and narrowed down my numbers, but I can only invest, $2,000 a month. But I really want to push forward and really try to get FIRE, right? Financially independent, retire early. Let's say that's your ultimate goal. Maybe you want a fat FIRE, right? I want a fat FIRE. Fat FIRE is just a more luxurious, FIRE retirement, right? You're able to spend more. You have more money to spend. That's like fat FIRE. Let's say you've capped out, which you will. You're in a baseline because we only make a certain amount of money. And no matter how you arrange your numbers, you're going to reach that point where you can't really invest anything more on your current income. That is when you got to find ways to then make more than what you currently make. As you increase your income again, you run your numbers again, you adjust, and now bang, you have more money to invest. Then you invest more. And then as you invest more, you protect more, and then you invest more in quality assets. And then again, you're going to reach another point where, okay, I kind of reached my baseline again. We'll try to find ways to make more. The one cap you're going to find to the speed of this all, friends, of building wealth over time, it's going to be the ceiling to how much you make. You're going to hit that baseline once again. So the only way to really fast track this whole entire process is investing more. But how do you invest more? You got to make more. You got to make more and invest more. And that's the cycle here that I'm just trying to paint the picture of. You protect what you make, you invest in quality assets, and then you make more than what you currently make to elevate yourself again, to have more money to invest, and then you invest more. I mean, that is how I'm building wealth over time. Let me just give you a really quick scenario. For me, I've invested money. Right now, I'm at the point where I've kind of reached my limit to how much I can invest. I do get annual raises, but they're very small. But what I did, friends, to try to make more money is I went back to school to get my master's degree because I realized at some point a door is going to be able to open for me for significantly higher pay, doing the same RN work, but significantly higher pay. And that's what I've done. Alrighty, friends. Here we are once again, as always, in the Jesse's Cash Flow Portfolio. My name is Jesse, if you couldn't tell. We're currently at $72,798.45, which is pretty noticeable from the last video. And trust me, friends, I only invest $100 every week right now. I wish I could say it was more. If you've been here a while on this journey, you know at some point when I first got into the workforce, I was hitting it heavy. I did $500 every single week. But right now it's $100 every week, and I'll explain a little bit more as to what my current and future plans are when we get to that segment. But here we are currently, friends, with a return of 31.14%. This is all time, and that equates to a total gain of $11,242.86. It's not a growth portfolio, but that's pretty good, I would say. But just to kind of confirm here, July 20th is when I started this. And as you can see by the chart, it has gone up steadily over time. We've continued to funnel and fund into this portfolio, and the drip has been activated the entire time, if you're curious to know that. And as we make our way downward, if you're curious about how to take a look at my pie, because I only really go into so much on these videos, I feel like it'd take too long to actually break down every single sector. But if you're curious, friends, I have a link in my description box down below. M1 Finance has links that are very easily shared, and you can click on that and take a look at your own leisure what exactly I'm holding. But as we go down here, let's rearrange it by total gain. So of course, tech is actually my biggest sector return at 167%. And if we were just to click on that for a second, you're going to know it's NVIDIA. I mean, NVIDIA has been a hot stock for a long time. It's been part of my portfolio since I started my portfolio in 2020. And it has been paying not only dividends, a small amount, but it's also been having great returns and growth. I mean, look at that, 499%. I mean, it's so high where it's like it's a little worrisome, and the smart thing to do might be to sell it and, disperse it, maybe take some of these gains. But the reality is, friends, I never plan to sell anything in this portfolio. My strategy is to buy once and let it ride until I'm given a reason to actually sell a holding. Reasons would be a dividend cut, dividend decrease, things like that. Those would be indicators for me to, hey, let me look into this a little more. Let me decide if I actually want to hold it or not. Having a super outstanding growth of 499% is not super concerning for me. Oracle's following Apple. Looking at crazy. IBM. Visa is actually at 21%. Now just going back here to, our growth. So energy is actually 100%. Next, consumer discretionary. I got financials at 46.41%. It looks like until we get to healthcare at 3.54%, negative, and then real estate is also negative, and then communications is negative as well. Real estate, I mean, it's kind of expected to be in the red. It's not, in the red by a lot. As you can see, 3 out of my 5 holdings are actually in the green, and it's actually AMT that's been in the red. And I remember when I first started my portfolio, people were talking about AMT. I did my research about it, AMT, and it's funny. If you listen to other people, you got to be careful. Maybe what everyone's talking about at a certain period of time as being a good holding may not always pan out. But like I said, because it's in the red, I still hold on to it. I buy once and I hold. If it's not worth keeping forever, I will eventually cut it. But until then, it continues to pay a dividend, and it doesn't worry me so much. And I just want to set this to actual target allocation here for a second. And just to show you my ascending or descending order here of holdings. So real estate, despite it being in the red, I have it set at 13% of my dividend portfolio. I really like real estate. If I was able to hold it in person today, I would hold some. That is kind of my next goal, which I'll talk about. But I just hold it in REITs for now. Followed by consumer staples at 12% and ETF at 10%, all the way up until it changes at financials at 9%, industrials, another one lower, healthcare lower, communications is at 5%, energy at 3%, materials at 2%, and this is my McDonald's. I don't even say consumer discretionary anymore. I just say, yeah, this is my McDonald's. And that's about as deep as I get into this area, because if not, I could be here all day talking about this. There's so much to talk about, so much depth in here. But if you have ever any questions about anything in particular, friends, just comment down below. I'll make sure to respond to you. There's a lot to unpack there, so we'll leave it there for now. And let's just go into the activity section, because this section is always quite fun, to be honest. It's where all the dividend payouts are. It's all that money making happens. You got Oracle here at $2.62 dividend payout. Comcast paid out $5.92. Cisco paid out $4.18. And as you go down, you're going to see more and more dividend payouts. You're going to see one of $15.67 by Avalon Bay, which is a REIT. Medtronic paid out $12. What is this one? AMT, look at, we just talked about how bad they were. And here they are paying $11.85 in dividends. I'll take it. And as we make our way forward still, let's see. We'll go into a little bit more of the data of the portfolio. As you can see here, I hold 51 holdings. My dividend yield is 3.168%, and my expense ratio is 0.01%. Let's start with the expense ratio. It's very, very small. But friends, you got to be careful if you want other people to manage your money with ETFs and funds. You got to be careful because the expense ratio is going to be higher, which is fine. I like being a little bit more hands-on. I will bite the bullet per se if it does poorly, and I will ride the wave as it does very well. But this also comes with, the expense ratio having to change depending on your strategy. Typically, if you manage your portfolio on your own, it's going to be a lower expense ratio. If you have someone else manage it, it's going to be a higher expense ratio. I've heard and read articles that even just 1% can take out a huge chunk of your portfolio over the span of 20 to 30 years. So just kind of keep that in mind. My current dividend yield is 3.168%, and that's pretty much exactly in line with where I want it to be. I like anything from 2.8 to 3.2%, just for my own level of comfort. There's people who are dividend yield chasers, and they go buy and sell and trade just for the dividend yield. I highly go against that. That is not my strategy. But that's not to say the people that go into that strategy are doing it wrong. That's just their preference. That's their risk tolerance. That is not mine. I like to watch paint dry. I like to take a slow and steady approach, and I like to leverage my time. I'm 27. Even if I put in 24 years from now, I'll be in my 50s, and that is perfect for me. And as far as my holdings, yes, I do have 51. As you can see by my return, it has not really made an impact on my return for my portfolio. I would even say, given all the shakiness in the markets, being over diversified isn't a bad thing. I mean, what more? I have a 30% return. How much higher can it be? It's a dividend portfolio. The only reason why I have this confidence now is because of the results. Maybe it changes later. Maybe I have to make adjustments. But since the beginning of this portfolio, friends, my strategy has always been to be diversified. And I did have 51 holdings from the beginning. So yes, when I first started this dividend portfolio and I invested, $500 every week, I had 51 holdings. When my portfolio was at $2,000, I had 51 holdings. My idea has always been the least maintenance as possible for my portfolio. If I buy a bigger pair of shoes when I'm younger, maybe they don't fit, when I'm younger, but they're going to fit one day. I'm going to grow into it one day. My idea is to have $1 million dividend portfolio. So yes, 51 holdings when my portfolio is $1 million is going to be viewed at differently, maybe, than right now at $70,000. And that has always been my idea. And so far, I'd say it hasn't really been giving me any negative aspect. It has only been positive. 30% return has been pretty good. And as you can see, it's hard to really know which stocks are actually going to be in the green. I mean, everyone was talking about AMT. People were like, oh, NVIDIA pays a low dividend yield. And look at it. So sometimes you just don't know what's going to happen. You just have to pick a strategy and go with it. Make adjustments as you go and as you move. It's all up to you, friends. And then let me just talk really quickly about my long and short-term plans. So if you've been here for a while, friends, you've seen some adjustments and some pivoting along the way. As I've said, I've invested $500 every single week when I first started. Now I invest $100 every week. That's an adjust and pivot moment. The main reason for that, which is part of my short-term plan, is I'm trying to save up money on the side for real estate. I want to get into real estate, be smart about it, get a good rental property, and ultimately rent it out. Become a landlord in that sense. I grew up watching my dad be a landlord. It is ultimately what allowed him as an immigrant to, make $30,000 a year, but then have an apartment complex that then pays him a lot more and have us live in a way better neighborhood, that people who typically have gone to school and gotten great careers live in. But that's the power of real estate. And I don't negate that. I'm only mainly a dividend investor because I know the headaches of being a landlord and the upfront cost it takes to get your foot in. And, people say, there's workarounds, but I'm just going about it in my way until I start to learn more about different ways. But this is how I've been kind of diverting my energy. start as a dividend investor, and then get into real estate. That is kind of my flow. And I've had this image for quite a bit now, and I'm just kind of letting the plan unfold. All this to say, right now my short-term goal is to save up for real estate, and then my long-term goal is to retire at the age of 50. Retire at the age of 50, which is very young. I work for the state currently. If I could stay a state worker and build up a pension on the back end and make a good amount on the front end and then invest on the side ends, right? Dividend investing, real estate investing, I should be able to retire comfortably at the age of 50. I should. I mean, my pension, I can grab it at the earliest at the age of 50. And after 26 plus years-ish, that should be pretty good, pretty solid. But then everything else that I've done on top of it will just make it that much better. And that is the plan. Retire at 50. You should always think about it. Even if you're not super close to retirement, you should have a goal in mind of when it is and what age you want to retire. That part is quite important. So now with the plans out the way, friends, let's get into one of the best parts of the video, which is my favorite part, which is to see how much my portfolio at $72,000 currently pays me in dividends. So let's take a look. So as you can see here, friends, $72,807.69, and M1 says $72,798. There's a slight discrepancy somewhere, but I couldn't really tell if it was on my end or just the end of the app. Maybe they didn't calculate the status of the current price of the stock. I don't know exactly what happened. I went through it a couple times, but we're close enough, I'd say. But here we are, friends, close enough. And as you can see, once I move over to my annual dividend income segment here, you can see I get paid $2,166.82. On a monthly basis, it's $180.57, which is pretty good. On the daily, it's $5.94. And my current dividend yield here, according to the Div Tracker, right, this app, is 3.34%. So there's always a little bit of a discrepancy. I think we were at 3.16 or so on M1. So I like to think of it being somewhere in between and maybe leaning even closer to what M1 says. But regardless, it's still in alignment with what I like and my dividend yield. Anyways, friends, that's going to be it for this week's video. I couldn't tell if this one went a little longer than it normally does. I think it did. I might have rambled, have a lot of energy right now for some reason. Actually, I know why. I drank some coffee and it's early in the morning. I'm about to hit my workout. And if you're curious, if you've made it to this last part of the video, friends, I do like to just share. If you want to continue to follow me in my journey of personal development, just career, my success, and life in general, as I try to work on that, I do have a second channel. It's called ContinuesToImprove. Go ahead and check it out and subscribe to that if you haven't yet already. If you haven't noticed, I only submit 2 videos every single month on this channel, but on the other one, I submit multiple a week. But now I know I'm rambling, friends. I will see you on the next video. As always, continue to invest, continue to improve. It will pay off. It will pay off. See you then, friends. Take care.